Hello, hello. Welcome to tonight's session. Go ahead and get rolling here in about 30 seconds. Hope everyone's having a fantastic day. Let's go ahead and fit that screen. Tweaked with the stream settings. Hopefully this is a little better. I know audio was kind of wonky the last time we ran a public webinar. So we're going to see if this works a little better. Thank you so much for taking the time out of your night or day, depending on where you're at, to listen to me yap about charts. We're going to go ahead and get started. Over the next 20 to 30 minutes, we're going to talk about what I think are the most important charts for the end of the year. Everything that we do inside of TTI is 100% price driven. Nothing you see is going to be my opinion or bias. It's entirely based off of what we see on the charts via price. Before we get started, quick disclaimer. Please do not be stupid. Please do not risk more than you can lose, and don't misconstrue anything we say today as buy or sell recommendations. We're just talking charts. So without further ado, I want to take about 3 minutes just to talk about our process so you understand why the charts I'm about to show you matter to us. We utilize something called a top-down approach. The top-down approach is vastly different than most discretionary traders that focus on single stock setups. We focus on the bigger picture first, but we do it within the confines of price. So our beginning stage, and arguably the most important, is we have to build that bigger picture. We build that bigger picture through looking at macro price data. I want to say that again, macro price data. None of it is economics data based. None of it is vibes trading. We're not looking at whether or not Kamala Harris or Donald Trump are going to win and then pretend to know which stocks are going to do better under that regime. None of it. 100% of it is going to be based off of price, particularly things like sectors and industries, which we'll get into in a second. Second, we then go and try to find the right trading vehicle to express the bigger picture. So if we are, for whatever reason, seeing data that tells us we should be long financial related stocks, we're going to go and find the best possible trading vehicle to fulfill that bigger picture. And then lastly, which is what the most important piece is to the bottom-up process, but not so much the top-down, is manage the risk and reward on the trade. From a top-down approach, if you're at least batting within the right universe of stocks, generally you're going to make a couple bucks. So managing the risk to reward on a trade comes last. We have to get into the right ball field first, get the right pitches going, right? So two components of our system. One, we have a strategic outlook and then a tactical outlook. So our top-down approach, the strategic component, we try to contextualize the bigger picture. And as I had mentioned, we look at major market trends in sectors, industries, market caps, different asset groups, etc. We're looking at everything in the market in totality, but once again, based off of price. Our goal, hopefully, is that we want to know where the big money is flowing and follow it. I shouldn't need to prove this to you, but retail traders do not move markets, right? We're looking at a $3 trillion stock in NVIDIA. It doesn't matter how many of you and your boys want to buy it. Regardless of how much cash you have in your Robinhood account, you're probably not going to move NVIDIA a single penny, regardless of how much you YOLO into an options play. Our focus is entirely on the bigger picture and where the passive ETFs are, the large money managers, we're talking billions under management, etc. Those guys move the markets, and so we're trying to find where those guys are making splashes in the market. Secondly, tactical. We want to leverage our expertise in technical analysis to highlight high risk to reward setups that best express the views derived from our strategic research. So once again, we figure out where the big money is going, we ride the trends, we find the right stocks to take that trade idea, and then we manage it. Everything we do inside of TTI is minimum a 3-to-1 setup, but typically we only target 4-to-1 or higher, meaning we are only willing to take a trade if we can risk $1 to make $4. That means we can screw up a lot and still make money over the long term, which you're going to see in a second. So before we get started on actual charts, I want to ask you a question. Mystery chart, is this a long or a short? You cannot say sit in cash. Is this a long or a short? Well, most people would say this is a downtrend. It broke whatever support level that is at the one area and is continually hitting lower lows. Most people would probably say this is a short, right? It's reasonable. And if you had been short this for an extended period of time, you would have made a lot of money. So to the bear's credit, you have not got blown up the entirety of the year had you gone short. unless, of course, you realize that it's just an inverted monthly version of the daily S&P 500. That is an exercise that we utilize inside of TTI often. If you thought this was an easy short, you should equally think that this is an easy long. It's the exact same chart, just turned upside down. That's to reveal something inside of you. Bias. If you're naturally bearish, it's going to screw you in the long run. There are times to be defensive. There are times to be bearish. When markets are hitting all-time highs on a week-over-week or month-over-month time frame, it's not the right time to be bearish. The S&P 500 consistently hitting all-time highs on a week and month-over-month time frame. This is your daily. We consolidated at our first profit target, that 1.618 fib extension through the entirety of the summer. We resolved higher in September. We fully expect the S&P 500 to be testing the 600 area before it even gets close to testing the 500 area. For everybody out there that thinks this market's about to roll over, there's a lot of work to be done on an index standpoint to really substantiate that claim. We're looking at this as a possible opportunity to continue to participate to the upside in a bull market. Secondly, check out that 200-day moving average. I'll tell you right now, if you've been in the market for a while, you know how hard it is to short a market, excuse me, that is trending above a 200-day moving average. We consider this inside of TTI the primary trend. Mr. Paul Tudor Jones, very famous investor and trader, says nothing good happens below the 200-day moving average. We take it a step further and say you shouldn't be looking to short above the 200-day moving average. The primary trend will typically continue to push stocks higher in this type of environment, and that's exactly what we're seeing. If we look over at NASDAQ, the Qs, it has yet to re-break out into an all-time high after tapping an all-time high and consolidating here since the beginning of summer, since the beginning of July. Now, you could certainly make a bearish case here. We have yet to hit all-time highs. There is waning momentum. We are potentially starting to top out right now. But inside of TTI, precedent matters to us. Primary trend matters to us. The weight of the evidence, which you'll see in a second, matters to us. So we do not think this is a topping pattern whatsoever. We look at this as a consolidation pattern within an ongoing uptrend. You'll see in a second why, but once again, we're trading north of an upward sloping 200-day moving average. That means the primary trend is still intact upwards. The RSI is still, for the meantime, trading above the 50 RSI, meaning bulls are in control. We have, if you're a technical trader, a massive consolidation fractal. And what I think really validates this consolidation fractal, and this goes back to old school technical analysis, what you like to see is waning volume. You like to see tightly consolidated price fractals with waning volume. I drew that arrow down there along the volume histogram to show you that, yes, in fact, we have been drawing down in volume through this continuation fractal. Stats have proven time and time again, this is not my opinion, that breakouts on declining volume through continuation fractals tend to sustain themselves. I will say, though, that the Qs have not yet really broken out. We do expect them to. We expect this to resolve higher, and I'll prove that point in a second. From a pure TA standpoint, this is still an uptrend in the NASDAQ. Market breadth was a big issue for a lot of traders for a long time, and I totally understand. It's something that we monitor on a day-by-day basis as well. But we do not live in an equal-weighted world. The benchmark is a non-equal weighted index. The S&P 500 is non-equal weighted, meaning the largest and strongest companies in the market are going to be weighted higher. So you will have market environments where the largest stocks in the world are going to pull the index higher, even if a majority of the stocks in the index are not performing. What RSP does is it gives us an equal opportunity to look at all of the stocks in the S&P 500, the average stock. And I'm sorry to tell the bears, a couple of months ago, we broke out of this consolidation fractal going back to the beginning of 2024, and we've continued to hit all-time highs. So from a market breadth standpoint, you cannot use the excuse that market breadth is declining anymore. As a matter of fact, up until the last few days, it has been screaming higher, and we expect it to continue to scream higher. Treat this chart just like any chart. If it's trading north of a 200-day moving average, if the RSI is above the 50 and you're in towards all-time highs, it's very hard to be bearish here. Not saying it can't be a top eventually. It just doesn't seem like it is based on the weight of the evidence, primary trend, momentum, everything else. The simple fact that it's hitting higher highs. This is TA 101. So from a market breadth standpoint, the S&P 500 at all-time highs. The NASDAQ has been weaker. We've talked about the underperformance in the tech sector almost all year. We'll look at that chart in a second. The tech sector outside of the semiconductor industry group has not performed well over the last 10 months. Software, which just broke out to all-time highs, took forever to get moving, right? Software stocks have taken forever to get moving. Semiconductors have not done a whole lot since the second quarter of 2024 outside of NVIDIA. And so what we're looking at is a lagging NASDAQ, which if you're inside of TTI, you know we're not strictly a high beta tech trading group. We have positions across all different sectors. We have utilities trades on right now, which by the way, utilities all-time high and leading sector year to date. We have financial trades on. We have industrial trades on, right? We're not this group that pigeonholes ourselves into only Apple, Microsoft. We'll take those trades when available, but we look at the totality of the market. And as of right now, if you are a high beta tech trader, it hasn't been a fantastic year. It's been probably pretty challenging. Now, I do want to point out that just a couple days ago, the NASDAQ did break out into all-time highs. Or excuse me, the equal-weighted NASDAQ broke out into all-time highs. Coincidentally, so did software industry group. We saw lots of software stocks break out finally after a 7 or 8 month consolidation phase. And so we do think this is the beginning of a bigger move. Now, having said that, if we look back at the Qs, we're in a massive consolidation fractal in our eyes. We have declining volume. We're expecting a resolution to the upside with momentum. If we look at the equal weighted NASDAQ and we already see a series of higher highs, the equal weighted NASDAQ has already hit an all-time high. We believe that the innards, right? The average stock in the NASDAQ is already participating into these all-time highs push. What we need now are the Mag 7 stocks, which we'll talk about in a second. We do not know whether or not earnings are going to be the catalyst to push these all-time highs. That's not our edge as a trading community. We don't try to predict price movements off binary events. You want to gamble, feel free. We don't do that though. We do think that if the market does like the earnings, like Tesla, by the way, today, I think it's up 8 or 9% after hours. We do think that's going to cause the NASDAQ to break out of this consolidation fractal and begin the next leg up. Once again, market breadth is not the argument here anymore as the equal weighted NASDAQ has already broken out. So nix the market breadth argument. It's not valid anymore. Let's move on to just straight up trends. This is something we look at inside of TTI every single Monday. Every Monday, we look at the S&P 500, the NASDAQ, and the Russell 2000. We want to know right from the very beginning, get all of the crap we've heard about over the weekend, the global politics, unfortunately, the global wars going on, the election, all of the crap, get it out. Where's price in relation to the short, intermediate, and long-term trends? Where are we? On Monday, this was full bull, but one thing that TTI members can absolutely agree on is that we had been in a long-term, intermediate-term, and short-term uptrend in the S&P 500 and the Qs for like the last 3 or 4 weeks, and it has been very good for us. We've been long. We've had a pullback over the last few days. We've noticed market internals kind of pulling back slightly since Monday. That's okay. This stuff happens. Oscillations happen within uptrends. It's not freaking us out here. But something that I encourage you to do, whether you join TTI or not, is keep some sort of checklist that gives you an opportunity to figure out where are the indexes trading in terms of short, intermediate, and long-term trends. Try to take the bias away. Who gives a shit about the election? Who cares about Ukraine in regards to trading? Who cares about what's going on in the Middle East? We don't care about BRICS. None of it matters. We don't care that your neighbor lost his job or that your cousin is on food stamps. None of it matters. None of it. You have to be able to focus on what the market is doing based off price. This is a steal it. I don't care. Fantastic place to start every Monday morning. It's going to keep you from shorting strong uptrends. I guarantee it. Let's talk about market breadth from a different perspective. We looked at equal weighted S&P and the Qs. Let's talk about stocks above their moving averages. We have started to pull back this week. I'm sure you saw it today. Qs were down over 2% at one point, closed down 1.5 or 1.4. The S&P a little less, the Russell a little less. What we're seeing in the S&P 500 is that stocks below the 20-day moving average, which is what we would constitute a short-term trend, are breaking down. But is it causing a material impact on the intermediate and long-term trends? Absolutely not. We're still holding below the September lows, and we're very much above those August 5th lows. And for those of you that weren't trading on August 5th, the market really took a nosedive, right? That was the catalyst that we expected. Hey, if this bull market is over, those August 5th lows are going to be a pivot point to get short. Thankfully for bulls across the world, those August 5th lows were never retested, and it ended up being a fantastic opportunity to actually scale into stocks showing strength through those lows. What we're seeing right now is a pullback in the short term, but it has had no material impact in intermediate or long-term trends. So if you're like TTI, if you're like me, I like taking trades with anywhere between 60 to like 180 days of expiration. I'm not worried about stocks below the 20-day moving average. It's not going to dictate how I maneuver through the market, but it is something that you want to monitor, because typically what we see, particularly on significant moves to the downside, is they do start impacting intermediate term trends. And that's when maybe you want to start playing a little bit more defense, right? Playing a little bit tighter stop losses, taking profits a little quicker, things like that. As of right now, we haven't seen it. We're still bullish across the board, by the way. Speaking of those August 5th lows, I want to get into sector performance. I told you we try to draw this broad picture, and we really get a lot of alpha. We outperform the market by looking at sectors and industry groups that are outperforming the market. How this works within a bull market is different sectors tend to rotate throughout the maturity of the bull market, meaning for maybe 1 or 2 quarters, you're going to have technology really outperform, and then you're going to get these really frothy moves in certain areas, particularly we'll say like semiconductors. And then generally what happens after extended moves, you get consolidation phases. People are taking profits, right? Bigger institutions are either offloading shares or they're trying to accumulate more. And so that tech sector, in this example, would pull back. Though that money doesn't just leave the market. It rotates into some undervalued areas of the market via sectors. And what we want to do is we want to catch the coattails of those sector rotations as early as possible. That's really a huge selling point, not only for our system, but for a portfolio. If you can take advantage of sector rotations and ride these things for as long as they're outperforming, you will outperform the benchmark, and the individual stocks within these sectors outperform the sectors. So for example, financials, which are leading off the August 5th low, that's a very important date in the market because that signified the opportunity for this bull market to end, and it didn't. We rallied off of that. The Japanese yen carry trade blow up. That was the doomsday of the summer. Didn't happen. Financial stocks have rallied 15.77% as a sector. But as you'll see in a second, we're going to talk through 3 very important financial stocks in particular. Those things are up 30, 40, 50% on the year. So sector rotation is important. Having said that, look at the sectors that are leading right now off the August 5th low. Tech might feel terrible. But up until today, literally today's close, tech was leading off the August 5th lows. And if you're inside of TTI, we got long tech very early on that drawdown on August 5th, right? The next week, we were buying tech, the strongest stocks within the sector. And for the most part, they've done goddamn well. We have a bunch of trades that are free heading into earnings and into 2025 because of that. But financial stocks are doing well. Utility stocks are doing well. And before anybody says utilities outperforming is bad for the market, the 2 biggest stocks in the utility sector, CEG and VST, by yearly performance are nuclear-powered companies. They build these nuclear reactors, and I would consider that an AI extension trade because Google and Amazon and Microsoft and Meta are giving them billions of dollars to build these power plants to facilitate the AI boom. So is it really defensive that these 2 stocks, which are carrying the sector year to date, are outperforming? Nope. To me, that is risk on as you can get. Bring back nuclear power, baby. You have industrials, which is a grab all sector. You have consumer discretionary, which is your Teslas, your Amazons. You have extra money. Where do you go and spend it? General Motors, for example, yesterday reported up huge. These are the stocks outperforming off the August 5th lows. Now, I shouldn't have to ask you this, but does that seem bearish? The weight of the evidence, primary trends are intact. Market breadth looks pretty goddamn good. Short, intermediate, and long-term trends. Short term's pulling back. Intermediate and long-term trends still look great. And risk-on areas of the market are outperforming the benchmark. This is data-driven research. It's not my opinion. You have the data in front of you. Is it bearish when banks are outperforming? No, historically it's not. Is it bearish when tech is outperforming? No, historically it's not. Utilities, consumer discretionary, etc. So once again, I know there's probably people watching this either now or in the future that want me really badly to say the market's about to fall. It might. Certainly doesn't look like it yet, though. Talking about financial stocks, JP Morgan, Goldman Sachs, and KKR, 3 very, very important stocks in the financial sector, are all trading at all-time highs. Say that again. 3 of the most important financial stocks, and JP Morgan is the most important financial stock, arguably the most important bank stock in the entire world, are trading at all-time highs. Is this bearish? If you like burning through money, I entirely encourage you to short uptrends, particularly into all-time highs. If you like throwing cash away. Conversely, if you like making money, it's probably not a bad idea to get exposure in leading sector groups with the largest stocks within that sector breaking out to all-time highs. If you can hold on, you're probably going to make a couple dollars. And we do have trades in those stocks, by the way. Let's talk about arguably the most important industry group. Let's be honest. This is the most important group of any stock in the entire world right now, the semiconductor stock. Now, you could make a bearish point here if you want, and I would entertain it. I think that this thing could really go one of 2 ways, up or down. Imagine that. You could make a compelling bearish argument here, and I wouldn't really refute it. But I want to make the bullish argument because there's not many bulls out there willing to argue for semiconductors continuing to rally. So I'm going to argue this using the same points I just argued with SPY and the Qs. Primary trend is still up. Upward sloping 200-day moving average really doesn't make us all that bearish. Now, we are getting very close to that 200-day moving average. As you can see, we've almost tested it back in August. Excuse me. And then we did test it at the beginning of September. So is this still the most bullish area of the market? No, I don't think so. Now, from a year-to-date performance standpoint, semiconductors have still, even with this pullback, outperformed every other industry group by magnitudes. Having said that, it's been a very challenging trade ever since the first or second week of July. The market is consolidating here. Whether or not this rolls over is anybody's guess. My money is on no, and I'll explain in 1 second using NVIDIA, right? Semiconductors here, primary trend is still up. The RSI for the meantime is still above the 50, which is bullish, but let's be honest, it doesn't look fantastic here. To me, this looks like the Qs, which shouldn't be a big surprise because NVIDIA is obviously a very influential part of the NASDAQ, but the semiconductor chart to me looks exactly like the NASDAQ, a massive consolidation fractal with declining volume, potentially giving us an opportunity to continue trading it long. The implication of this particular industry group breaking down is that the bull market is probably over at that point. Does the market have enough juice left in it right now to continue higher by buying industrials and materials and healthcare? Historically, no. Typically, we're going to want to see higher beta sectors and industry groups performing well. Semiconductors, which has performed the best off the 2022 low by magnitudes, by the way, the closest industry group outside of semiconductors, home builders. So if semiconductors roll over here, it's hard to imagine this bull market continues at least with the ferocity that we've seen over the last 2 years. Typically, these types of moves last 3 to 5 years. We're just now starting our 3rd year. So once again, I entertain the bearish thought. I do not think it's there yet. But we have to call a spade a spade. It doesn't look as fantastic as it used to. Having said that, NVIDIA is clearly the most important stock in the market. It moves sentiment. It continues to hit all-time highs. And I do want to point out that even though NVIDIA is at all-time highs, TSM is at all-time highs, Broadcom, ticker AVGO, is at all-time highs, semiconductors as an industry group have yet to really break out again. They're still consolidating. So you have to ask yourself, and this is something we ask ourselves inside of TTI all the time, is NVIDIA going to pull everything up higher, or is this an epic fake out for the bulls? Well, I'm going to tell you something right now. We're long NVIDIA, and we have a completely free position, meaning we've already had over 100% profit in the position. We've taken half out. We're only trading with free unrealized profits right now through earnings. We have a price target of near 150 and then 170. If earnings continues to push NVIDIA higher into this bullish uptrend, which so far it has, we're going to make a lot of money on this trade. Here's the trade-off. If NVIDIA doesn't do well for earnings, or the market for whatever reason doesn't like it, we're going to lose $0 on the trade. I talk about this all the time, but this is an opportunity for those of you not inside of TTI to write this down. I call them asymmetrical trading opportunities. If you're trading options, you take half out of the trade at 100% profit, you now have what we consider a free trade on the books. You're playing with only house money. At that point, you have zero risk against your account. It's a lot easier to trade It's a lot easier to hold for the bigger move. And quite frankly, within a bull market, a lot of these stocks, even though they consolidate, do continue higher. So NVIDIA, we are long. I do think that if NVIDIA is hitting all-time highs, the semiconductor space will continue to hit all-time highs as well. This is the flagship stock. Once again, TSM just reported, blew expectations out of the water. We're in a free trade in that as well. Broadcom's at all-time highs. We have a slew of semiconductor earnings coming up. So obviously we're going to know more in about a week, week and a half. And I think NVIDIA is in November though. So hold your butts, but semis still look okay here. Talking about NVIDIA and being the most important stock in the market, let's talk Mag 7 in general. Mag 7 stocks, meaning Microsoft, Amazon, Meta, Google, Tesla, Apple, and NVIDIA. What I did is I just added them all together and it gives us this beautiful kind of look at the entirety of the Mag 7. We call it the Mag 7 index. It's aptly named. We treat this particular chart the same way we treat every other chart. Where are we in terms of the primary trend? Are the Mag 7 stocks starting to break down? If they are, I'm going to tell you something right now. We alluded to this at the beginning. We live in a non-equal weighted world. The S&P 500 is the benchmark. It is non-equal weighted. The Qs, which a lot of traders follow every single day, is not equal weighted. Meaning your Microsofts and your Amazons, your Metas, Googles, Teslas, Apples, and NVIDIAs are going to be worth more from a weighting component than the other stocks within the index. So to us, this is a very important index to follow. What are the strongest and largest stocks in the world doing right now? For us, they're approaching all-time highs. Like most of the market hitting all-time highs in July and then consolidating through the summer. It has yet to break out back up and over those July highs, but we're trading north of a 200-day moving average, sloping upwards. We're starting to break below the 50 RSI, but we'll see what happens tomorrow based off of Tesla's earnings. This particular index keeps us in line with the primary trend that the indexes themselves are telling us. So Mag 7 index is up. S&P 500 and the Qs primary index are up. We want to continue to be more bullish than bearish. It's just that easy. It's going to be very hard for the market to roll over if the most important stocks by weight are not rolling over as well. I encourage you to steal that index. You can make it yourself in TradingView. The last chart, and then I'm going to show you some scans here that I want to go through, is our risk on versus risk off basket. So what I did here was I took a basket of risk on assets, things like copper, things like the Aussie dollar, the semiconductor space as a whole, high beta stocks, right? Stocks that move more than the benchmark. And then I divided them by a risk off basket. So traditionally, areas of the market that do really well when risk is coming out of the market, bearish scenarios. Things like gold and bonds, things like the utility sector, consumer staples sector. And what I did here is I'm trying to gauge sentiment for risk. Is risk entering the market? Are risk on assets outperforming, or are risk on assets underperforming the risk off? Now, this isn't perfect, but once again, I talk about this a lot inside of TTI. We look at the weight of the evidence, right? Weight of the evidence is important for us. One single data point is very rarely going to move the needle for us. But if we have 10 data points all pointing in one direction, now all of a sudden we have something there. We're building that bigger picture. So we have primary trends in the S&P 500 and the Qs up. Equal weighted S&P 500, equal weighted Qs are at all-time highs, right? They are. It's not an argument. Short-term trends are starting to break down slightly below the 20-day moving average, but the 50 and the 200 are still very much intact, which is indicative of a very strong bull market. We have stocks above their 50 and 200-day moving average, still above their September lows and nowhere close to their August 5th lows. We have the Mag 7 index still pushing up, potentially into all-time highs relatively soon. We have the risk on basket still pushing up, potentially. We just were at all-time highs a couple of days ago. Once again, it can be very, very hard to remain bullish when you're constantly being inundated by the media, the election crap, the guy on Twitter with 100,000 followers telling you inflation's high. None of it matters. Because listen, whether or not you think inflation is high, the market is a completely different beast. That's it. You can't sell your stock at what you want it to be. You can only sell your stock at what it is. So the most important thing you should be focused on is price. That is your leading edge. Everything in the market for us still continues to point bullish. The one thing I will tell you that does throw a wrench in our bullish thesis is the dollar, which I'm not going to go over tonight, but I guarantee you if you pull it up, just understand there's an inverse correlation between the dollar and stocks, and we're pressing up into that 2-year high. So the dollar definitely is the one wrench in our bullish thesis, which we talked about today inside of TTI. It's not enough for us to sell our stocks and get bearish, but it's definitely something to monitor, right? So if you have that on TradingView, either right now or tomorrow or tonight, I suggest you mark up your Dixie chart DXY and then compare it to your SPY. A lot of edge there. So I want to kind of wrap up this with a couple reports. So something that we do inside of TTI every day is we look at different reports around the market. If you pull up any scanner, you're going to have about 10,000 different things you can trade. ETFs, stocks, different asset groups, sectors, everything. Audio back. Sometimes the Yeti freaks out. I'll wait till you guys give me the thumbs up, but I think it's working. Go back really quick and I'll summarize this. Cool. Long story short, these are the strongest stocks. If you're looking for stocks to own in a bull market, some of these or a majority of these are probably not a bad place to start. I encourage you, pause the video, go back after this is over, take a screenshot, scan through these. We own probably 25% of this list, and this is the best year we've ever had. It's not a coincidence. Own strength in bull markets, you're going to make some money. That's how this stuff works. So this is probably the best scan that you can start with. Steal it, feel free. The next one I want to talk through is my favorite scan that we go through, at least this year. This is our Future Leaders Report. This is very different than our Heavy Hitters Report. So Heavy Hitters, 60 billion in market cap only. US domiciled, generally not all low beta, but bigger stocks. This particular scan is looking at recent IPOs. What we like about recent IPOs, during certain market conditions, and this is not always, by the way, so use this report when the market's hot, which it is right now. It's been hot all year. Our biggest wins on a percentage basis have come from this report. What we're looking for here are stocks that have IPO'd within the last 3 years. We throw our technical and volume filters on it once again. So what we're looking for is absolute and relative strength. We filter it once again by proximity to 52-week highs, and we utilize something we call our IPO range breakout. So if you're inside of TTI, you know this. If you're not, what you need to do as you scan through these particular stocks is look for a horizontal range. By the breakout of that horizontal range, throw a stop somewhere within the range and just say, listen, if we're above the range high, there's a decent shot that this thing is going to continue into something we call big blue skies, right? If you're an econ nerd, it's price discovery. You'll quickly notice that when stocks are trading, particularly recent IPO'd stocks, in this kind of price discovery mode, they typically run for an extended period of time. It's outrageous how much they run. I'm talking 50 to 100%. Look at Kava. Look at GVO or GEV. Look at Shark Ninja. Look at Nubank. Look at CART, VIK, ATMU, KVUE. We're in all of these. Look at CORZ. We have probably 50 to 75% of this list. These are the biggest movers on the year. Now, once again, during certain market conditions, do you expect recent IPO'd stocks to do well in a bear market? Hell no. Do you expect recent IPO'd stocks to be doing well in a market that is rolling over into a bear market? Maybe we're having some distribution on a massive scale. Hell no. So one leading indicator for us as we go through these future leaders reports on a day-over-day basis is if we start to see a lack of names on this list, maybe we should be looking at a bigger picture move. If less and less of these recent IPO names are showing up, maybe the risk off is starting to creep into the market, right? Makes sense? But right now, as you can see, we have 20 of them within 5% of their yearly highs. And a lot of these are at all-time highs. So once again, pause the video, take a screenshot, rewatch this part, scan through these stocks, throw them up into your favorite charting software, look for opportunities to enter those horizontal level breakouts, throw a stop somewhere within the range so you're not holding indefinitely if it doesn't work. These things are fantastic. The last one I want to talk through here is when fundamentals meet technicals. Everything we do inside of TTI is price-based. Everything. None of it is opinion-based, and we don't look at fundamentals whatsoever. So, of course, we're going to make fun. But having said that, Mr. William O'Neill of CanSlim is a very smart individual, and he's shown that over time, his basic CanSlim metrics tend to work. And so made a very, very easy report for me. I took his CanSlim method and combined it with our technical and volume filters. And what we're looking at here is a combination of stocks that are showing strong fundamentals based off of the CanSlim methodology, and the technicals and volume that we need inside of TTI to take a trade. It's an awesome scan. You're going to see a lot of overlap in this scan because price tells all, right? But it does tend to show us different types of stocks and different industry groups that maybe other scans won't. So in this case, the number one stock right now, which probably shouldn't surprise you, but it does surprise me, is a gold mining stock, AEM, which is at yearly highs right now. Kava, Shark Ninja, Granite Construction. There's a name that we went through in one of our monthly charting sessions. AppLovin is a name that we made more money on this year than I cannot believe how well we've done with App this year. But anyway, here's another one of those types of reports that will put you in front of stocks that look great on a fundamental basis based off of CanSlim and technical basis based off of what we're looking for. I'll tell you right now, it's never a bad thing to own strength in a bull market. Just like it's not a bad thing to short weakness in a bear market. But once again, we're not in a bear market. So to consistently look for shorts means you're living in la la land. It doesn't make sense. So, summarize here really quick. We're bullish. Surprise. The weight of the evidence continues to tell us that we need to stay long. We need to stay long. Primary trends are up across the board. Equal weighted ETFs are confirming that market breadth doesn't suck. Stocks above their short, intermediate, and long-term moving averages tell us that breadth doesn't suck. Leading sector groups, which are typically in charge during bull markets, are still leading and outperforming the benchmark, which you don't see in a market that is significantly pulling back or basing for some sort of nasty bear market reversal. We're seeing leadership groups continue to lead in Mag 7, and we're seeing the risk on basket still outperform the risk off basket. Not going to tell you it's always easy to trade, but if there's one thing you can take away from this, other than the fact that price should be the number one thing you look at, is that, what was I going to say? The weight of the evidence is always more important than what anybody else says online or any of your friends or relatives say in person. Take the weight of the evidence every single time. It will keep you out of trouble. Bull markets pull back, but look at this. We've been a group for 4 years. I don't know if Dom's in here right now because I think he's still at work. But these results are not alone for Dom. He's had back-to-back 100% plus years in a large account. We still have a couple months to go. We'll see if it continues to go. Reason why I post this is it can be very hard to hold winning trades. We're in an information age where we've never had more opportunities and access to instant information. And yet 99% of it is useless. It's noise. If it's not our system, build your own. Focus on something that will not be convoluted by other people's opinions. Dom is a great example of that. If he would have listened, or I would have listened, or anybody inside of TTI would have listened to the people that were screaming that this market was fake, a Ponzi, we have to fall. If we cared about what the Federal Reserve said, if we cared about what was going on in geopolitics, we would not have been able to make back-to-back triple-digit wins. That's not how this works. So once again, if it's not our system, use something else. Okay? My name is Hamilton. That's the presentation. Remain bullish. We should have a fantastic end of Q4. As always, the weight of the evidence should dictate everything that you do. I want to open it up for about 3 to 5 minutes of questions. If you have anything trading related that you want to talk through, I'll flip on over to TradingView and we can talk some charts. See if I can get over there. Here we go. Feel free. I'm yours for 5 minutes. By the way, here's that app trade I was just talking about. And we've owned it since $45. We made a hell of a call identifying this as a software industry group leader back in Q1 of 2024, and we've owned it since 45. Pretty wild. If you follow me on Twitter, which if you don't, I highly encourage you to do, at How to Swing Trade, we have made more 1,000+% wins in app this year than any other ticker. It's easy to see now, but I'll tell you right now, what you don't see is the stress of holding a bigger position up 1,000% and watching either the market pull back or everybody scream that it's over. Market's rolling over. This is the end. It's hard. That's why our community is so valuable, at least to me. Because everybody is in there, in the trenches, in the same trades going, I'm holding it. There's no reason to sell it yet. And you're like, all right, well, if this guy's holding it, I'm going to hold it. As long as the stop isn't hit, continue to remain in, right? You had a couple of questions, but you can't remember. That's fine. It doesn't surprise me at all, Robin. I want to know if you're in UUP. That's the bigger question. We talked about you today. This looks like something you probably would have been in and made money on. That's an ironic, yeah, so that's a great question. I'll talk about this really quick. Holding things through gap downs, it comes down to two things. One, either some sort of confidence in the trade idea, but I do want to point out, you should never get into the habit of holding a trade past your stop loss. Your stop loss was there for a reason. If you're a technical trader, your greatest edge outside of viewing price is simply stopping out of a trade when you realize that whatever idea you had is invalidated. No other trading style has that. Fundamentals don't do that. Sentimental traders don't do that. Social aggregate traders don't do that. Anything like that, right? Technical traders have a stop on the books. We say, listen, give me the rest of the money that I still have back because it's not working. So if you get stopped out on a trade, which we define as a close below the risk off level, not the beginning of the day, but close. So we typically close our bad trades at end of day. We'll stop out. The greatest risk management tool you can have as a trader, in my mind, outside of position sizing, right? Position sizing is always the most important thing. Never over position yourself in a single trade. Don't do it. You're not Stanley Druckenmiller. Playing aggressive defense with your stop losses is incredibly important. The reason why I bring up app is the fact that if your trade is free, so let's say you're in a trade already and it's up arbitrarily 132%. You should have already removed the initial 50% of the trade. Well, let's say you put $1,000 into it. You should have sold 50% and got back, 1,320, right? So you're in profit. You've removed your initial capital. Everything you have left is going to be, that's bad math, but whatever. Whatever you have left is going to be house money. This is an old George Soros idea. When you're playing with house money, it's easier to hold through pullbacks. I'm not saying you don't care about anything, but when you know it's unrealized profits, and if let's say the trade the other half goes to negative 100%, which it typically does not, but let's say it does, you lose commissions and time. Realistically, that's not that big of a deal. Let's say the trade becomes invalidated and you decide you're closing it at negative 50. This is still profit, which blows people's minds, which it shouldn't. It's just simple math, which I apparently can't do here. You close at 50% off, you're still pulling profit out of the trade. You're getting 50% back, and you've already pulled half out, right? So taking half off of the trade is arguably like your second best. I'm going to say first because most people should know not to overposition themselves. Like your best opportunity to hold through these exaggerated pullbacks, the volatility that the market is throwing at us, et cetera. So gold is ripping. Yeah. I'll be the first one to tell you that we had a position in gold in March and I sold it. And it was for January of next year. So that was a terrible, terrible sell. But I did add into the consolidation fractal. Also long silver. Finally, silver got the breakout. So those are two precious metal stocks that are working for us right now. If you haven't hit 100%, we don't do anything. Yeah, it's either 100% you take half off and then you continue to roll it out, or not roll it out, but you continue to move with it. If it doesn't hit 100%, you stop out at the stop out, or as Chad is alluding to right here, sometimes the stock is not going to hit your stop loss, but the premium is already down 50%. Let's say the stop loss is hit and your premium on your contracts are down 90%. If you want to stop out and claw back that 10%, you can. Most people don't. I'm not going to tell you whether or not it's the right or wrong move. I typically do stop out and claw back that 10%. I typically have a little bit larger position sizes, so that 10% matters to me. But sometimes the stop out on the contract or the stop out on the chart is going to, unfortunately, cause the premium on the contract to pretty much evaporate. We do things when we plan these options trades to mitigate that. Things like only buying when IV's in low, or low IV environment rather. So under 50 IV rank. We buy lots of time on these trades. So we try to minimize that, but it's always going to be a risk, which is why I continue to say the most important thing for an options trader, or any trader really, is your position sizing. You have to be able to understand your position sizing. And Chad, not saying you have a problem with position sizing, no idea, but we do have an article on the market research portal that goes through defining your 1R. Go and read it. It's in guides. It will help you understand what you should be risking per trade based off of your account size. If you follow that guideline, I don't know, 3 to 6 months, you can start to kind of maneuver around it, but you'll get a baseline of what you should be throwing into a trade. A single trade going to 100% or negative 100% that ruins your day or blows your account, you are never going to last in this market. It's cost of doing business. You want to trade a highly leveraged financial derivative, you got to play both directions. You got to be okay with the losses with the wins. I mean, that's how this stuff goes. But yes, to answer your question, Chad, I am still in XOM. I typed Chad. I do not stop out early. I do not care what the premium on the contract is. I stop out when the technical trade is over. If XOM stops me out and this is a total loss, that's going to be part of doing business. How many other trades are you currently in right now where it didn't stop you out and continues to run, right? So you got to take both up and down. Is it too late to get NVIDIA? Yeah, absolutely. If you're taking the same trade idea that we had, it absolutely is. The trade for us is already up 100 and something percent. So unless you want to pay literally 100% more than what we paid for us, it's very important to try to buy pullbacks and get discounts on trade ideas. What we do is we look at options, pricing, contract history to figure out whether or not we're paying too much for a trade idea. Not enough people understand that if you're trading options, you're trading a completely different financial instrument than the chart. We're using technical analysis to give us edge and direction. Technical analysis does nothing to give you edge in the options market. You have to understand the Greeks, right? So if I paid $5 for an NVIDIA contract and you're going to pay $100 or $10 for it, you're at a severe disadvantage, my friend, which is why inside of TTI, we constantly try to promote, is this a good deal? Is this a good deal? Sometimes we're going to find stocks breaking out that aren't good deals, and so we skip them because the risks are too high. Try to find where somebody 3 weeks ago or 3 months ago paid triple or quadruple what you're willing to pay right now. In that case, it's a good deal. Right now, NVIDIA, the same trade idea that we had, probably not a good idea to own it. All right, last couple questions here. Is the stop at the 786 fib? Typically, yes. The only time it wouldn't be is if technical analysis gives us the opportunity to move the stop loss up. I can't think of something off the top of my head, so I'll draw something. Let's say price is coming up and then consolidates and then breaks out. Let's say here's the, for sake of argument, here's the entry, the 1. And let's say here's the 786. And here's the 1. So just sake of argument here. By the book, around a 3-to-1 setup is always going to have, from a shares perspective, a 786 stop, a 1 entry, and then a 1.618 price target. It's going to be like 2.86, but around 3. In the case of a technical trader utilizing this, well, we understand how support works, right? Everybody, this is building blocks of trading. What we like to do is say, listen, we had a consolidation range right before the breakout. Does it make sense to hold this stock if it falls back in the range and then below the consolidation fractal? Probably not, right? There's support here now. There's previous price action there. There's people buying and selling here. You would expect from a very basic technical understanding that people would step in there, defend their purchase, and then continue to rocket price up. So what we would do is, or what we can do is, we can throw our stop somewhere underneath this support level. We're not invalidating the trade idea whatsoever. But what this will allow us to do is, instead of a 3-to-1 setup, this might give us a 4-to-1 setup or higher in some circumstances. So no, the 786 is not always the stop, but it is the default stop. Remember, price action always supersedes everything else. If you're trading shares, when you determine how to sell half, there's a guide on the market research portal. What we do, it's discretionary. Everything we're doing is discretionary. But on a 2 to 3x ADR move above entry, your entry is $1. Let's say ADR is 3. Stock's at $1.09, which is about 3 times your ADR. You should be moving the stop loss up to break even. You're not selling half. You're moving your stops up. Selling half is an options related strategy, not a shares related strategy. You're moving stops up to cover your entry. This is what's going to 99% of the time give you a break-even trade. Unfortunately for stocks, if price gaps down through your stop, which it can occasionally do, your stops don't get hit, you take a larger loss than expected. How do you combat that? Nobody ever wants to talk about it until they get hit by a really nasty loss. It will happen eventually if you don't respect position sizing. Yeah, I think that's a completely different topic, Chad, but you're 100% right. Last thing I'm going to mention, then I'm hopping off, is opportunity cost is a bitch. This is, once you get into being a profitable trader, and I mean this sincerely, I'm not saying like fucking, shouldn't swear, it's live on YouTube's. I'm not talking about like futures prop trading groups and crap like that. I'm talking legitimately profitable over the course of 6 months to a year as a swing trader, which means you've probably been trading for a couple years. Opportunity cost is going to be your biggest detriment. Opportunity cost meaning if you buy stock A and it moves up 5% over a month, when you had the opportunity to buy stock B and it moves 15% over the month, yes, you made money, but you made the wrong decision. You paid a 10% opportunity cost of owning that trade. That's huge. If you're a profitable trader, you cannot make these types of decisions often, or these mistakes. Why? Give you a great example. We had properly identified App as a leading software group back in Q1 of 2024. We've traded it all year. It's up 254%. Very obviously one of the best trades we'll probably make all year from a percentage standpoint. Let's say you wanted to own Datadog as well, which is another software stock. It's done nothing for 6 months, 7 months. From a shares perspective, it's trading at the same level as it did in December of 2023. So you haven't technically lost anything. But what did you really lose? Time, all the capital locked up for the last 10 months, and we'll just say App. Now, obviously, this is hypothetical because you have to assume that you had a decision to be made between App or Datadog. But for those of you that are consistently profitable, we do have those decisions every single day. Which stock deserves our capital? This is a very important part of the process that most people will never get to in their trading career. Inside of TTI, we do it every single Sunday live, right? So yes, great question, or a great comment, I should say. Is it worth holding a losing trade? While technically it's not losing yet, XOM, it does suck. It's cost of doing business, unfortunately. Thankfully, high fives all around. We didn't ape into 75 energy-related stocks, just XOM. So it's either, I'll tell you what, I longed XOM here, didn't work. I longed XOM here, didn't work. So I'm right there with you. Okay. Thank you so much for hanging out with me. It's Wednesday. Enjoy the rest of your day. If you're interested in our services, links are in the description below and on the website that you have the link to. If not, I hope you guys learned something, and I appreciate any comments you leave below on the YouTube video.